If you're an accountant, you are currently sitting on a melting iceberg. AI just isn't doing data entry anymore. It's literally interpreting tax code and reconciling ledgers. The era of being paid to know the rules, it's over. And it's time to stop keeping score for others and start owning the game. The death of historical work. Unfortunately, accounting is one of these jobs because it looks in the rearview mirror. It basically reports what's happened in the past. It's not a forward-looking business model. Now, there are projections, right? But in essence, accounting is always backward thinking. And the bad news with that is AI is perfect at history. It can categorize transactions and reconcile these ledgers instantly. And also, AI is very good at predicting the future, cash flows, all that stuff. So CPAs, you are in trouble. That kind of job, it's going to collapse to basically zero in the next, I would say, 3 to 5 years. AI is getting that good. And so you must figure out what's the pivot. And to me, the smartest move is to become the person who buys the farm instead of the person who counts the beans. And what do farms need more than anything to operate? They need equipment. And so my suggestion in this video is use your financial literacy in the CPA space to pivot into the equipment finance space. And let's discuss how you do that. Now, you have a great advantage because you understand the language of finance. And there is a translation problem for most people that get into the equipment finance business because they are not confident in the basic math of accounting or finance, or they believe they can't be confident in it. It's more of a psychological issue than anything. But you already speak banker. You already know what a healthy balance sheet and P&L looks like. You understand the advantage of Section 179 tax code, which allows businesses to depreciate and write off their equipment financing purchases. And you know this better than most people, especially the borrowers. So you are in a very unique position as a CPA because the business owner needs to buy the truck or the medical equipment or the restaurant equipment or whatever it might be. The lender needs to understand what the P&L look like, what do the tax returns look like, how's the credit profile look like, and you, as a person with CPA and financial literacy, you're the bridge between them. So in this game, you are already inside the biggest barrier to entry, which is financial literacy. You can decode all this. Why equipment finance? Well, one reason and one reason only. Collateral gives everyone in the transaction some sanity. CPA is number one. You guys are risk averse by nature. That's a good thing. Equipment finance, it's not crypto. It's not some risky thing. It's not venture capital. It's not gambling. It's asset backed. And if a deal goes bad, the actual asset, the truck, the machine, the medical equipment, it still exists. So that gives the lender safety and it gives them the ability to approve more deals and allow you to build more commissions into each deal because there's not the default risk. I love this model because it matches the conservative nature of a finance professional and you're not betting on a dream. You're facilitating a funding of a machine that prints money for this business. The write-off arbitrage. As a CPA, you might make $500 for filing a return, right? But from a finance fee standpoint, if you do a $250,000 deal, you can make $15,000. That's a very big discrepancy on what you're making. So how many times have you told a client to buy equipment this year to lower their tax liability? I bet a lot. You give them the advice, they listen to you because you're the financial expert. They bought the truck and the lender made the profit. You charge for the form, $500. They charge for the capital. They make the finance fee. So the logic to me is stop giving away the most profitable part of the transaction. Originate the loan you are going to recommend anyways. As a capital architect, your clients, as a CPA, they already trust you. You are their financial GP, a general practitioner, if you will. So this transition into the equipment finance space, it's not a career change. It's actually an upgrade and it's a value add. This is about leverage, and this is about stop trading time for money. You're trading your time for a wage, and start trading capital for leverage, which is yield, which is commissions. And this is about being an architect and not being an admin. The goal is to really build a book of business where you are the architect of your, not only your business, but your life. So here's the new hierarchy. At the bottom is your client. In the middle is you, the one that is able to access the capital that they need. And at the top is the equipment that they need. You are the one sitting in the middle of that flow. You help everyone move equipment, and you get paid a very healthy finder's fee. You already have the financial literacy that most entrepreneurs do not have. You just lack the vehicle. If you want to see how to structure high ticket B2B equipment finance deals, check out the link in the description.